I absolutely love dividend stocks. About a third of my portfolio is dividend stocks. They've helped me create wealth and beat the market over the long term. And right now, I think with the market at all-time highs, there are some great dividend stocks to buy. If you've got money to invest and you're looking to buy dividend stocks, I've got two I want to talk about right now. One is one of my biggest holdings. It's done extraordinarily well. Another's one that I don't own, but I think is really compelling for investors right now. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by the Motley Fool. If you're looking for even more great stock ideas than the two dividend stocks I'm going to talk about in this video, go to our special link. It's fool.com/unscripted. Go to that link. You can get access to the Motley Fool's 10 best stocks to buy right now. Our partnership with the Motley Fool is how we're able to make this content. So please give it a look. All right. The first stock I'm going to talk about is Brookfield Infrastructure. And I'm kind of known as the Brookfield guy. You look at it over the long term and it's done extraordinarily well. If we go back to the beginning of 2010, coming out of the great financial crisis, the folks at Brookfield were being really, really smart about how they were beginning to evolve and transition the business. And you can see the stock up about 362%. Then you throw the dividend and dividend growth on top of it, and we're talking a 9x returns over that period of time, which is an absolutely extraordinary winner. Now here, more recently, this is since the beginning of 2020, it has not been a great investment, particularly if we compare it to how the market has done over that same period, up 123%, about 15% a year on average, is just running roughshod over Brookfield Infrastructure over that period of time. Now, I love to buy winning stocks, but sometimes I see opportunities for stocks that I'm a big fan of, and I say, now is a time to be buying more of. And I think that's absolutely the case with Brookfield Infrastructure. Now, I think the market is sleeping on the transition of the business and how exposed it is to digital transformation around the world, the growth of artificial intelligence, so much more data that's being used, the energy infrastructure and the data infrastructure that powers the modern world. And this is a slide from last year's Investor Day presentation. But this one slide I think is so important because these are the areas where the company has been really investing the most money over the past 7 or 8 years, buying infrastructure in the natural gas industry. There's a global huge demand for natural gas, for cheap energy. If we look at what's happening, the conflict in Europe with Russia's invasion of Ukraine, Russia is no longer a safe, trustworthy trading partner for natural gas. A lot of natural gas in other places in the world. This is a company that's in the middle of owning the infrastructure assets to move it around, store it, and process it. Electricity, taking that electricity and transmitting it, distributing it to the end markets. They're in the middle of that. Data center business has grown a tremendous amount. They have a partnership with Digital Realty Trust, one of the big data center REITs, to help fund and finance data centers. Their fiber business is growing. They're starting to acquire towers around the world. So that whole ecosystem, they're right in the middle of it. And the other thing that I think that's important is talking about the strength of the business. I'm going to go back to the previous slide and I'm going to show dividends on it. If you go back over that period of time, again, stock prices climbed a mountain and then collapsed and kind of gone sideways for the past few years. Dividend is up 32% over that period of time. So the business continues to execute well, continues to deliver really, really strong growth of funds from operations and turn that into higher and higher dividends. You put all that and you put it together today, you have a dividend yield of about 5.4% for the publicly traded partnership. I'm going to throw Brookfield Infrastructure Corporation on here. It's the same investment in the same asset. The difference is the stock price is higher. The yield is lower. Now that yield, this is a qualified dividend, so it's a little more tax advantage if you're owning in a taxable account, again, for US investors. So that's the reason that the dividend yield is lower. The effective after-tax dividend might be closer to that 5.4% you're seeing for Brookfield Infrastructure Partners. But the key point that I want to stress here, this is an incredibly strong business, plenty of access to capital. I think it's trading for a really compelling price right now. All right, I got one more that I want to talk about, and that's McDonald's Corporation. This is the one that I don't own, but it has really moved up my radar here. This is one that the stock price really went on a serious roller coaster during the pandemic and has skyrocketed and continued to climb. Now, at the same time that that's happened, I'm going to throw the dividend on here. McDonald's has continued to grow its dividend because the business is extraordinarily strong and extraordinarily cash generative. The restaurant industry right now is going through kind of a tough period. You're not seeing the same store sales growth. The industry is in a little bit of a downturn. McDonald's is viewed as a kind of a safe harbor. I want to share one slide from a McDonald's presentation that I think really breaks down the strength of its business model. And the key thing is, if you start right here on the far right, McDonald's actually only owns and operates 5% of its restaurants. The vast majority of McDonald's restaurants are operated by licensees, and it makes its money. That's this yellow. That's the McDonald's yellow here. This is where McDonald's makes its money. And the vast majority of it is owning the real estate, owning the building. So the licensee pays McDonald's to rent the real estate and then pays royalties on top of that. We see another segment, it's developmental licenses. Its licensees actually take on more of the responsibility. They fund the capital to build and own the real estate. Of course, McDonald's doesn't get to earn the rent on that, but it helps with capital needs. McDonald's continues to earn the royalties. As a result, McDonald's is an extremely consistent cash flow, high margin, high profit business because it's so much based on licensing and fees. It makes it a really strong, really resilient business that makes it compelling. And if you look at it over the long term, even though this is a business that's been around for many, many, many decades, it's a highly competitive industry. McDonald's has been a market-beating stock, and the dividend yield's a little lower, around 2.3% of recent prices, but that dividend growth, along with that strong core business, the value of the real estate that they own and their ability to leverage that, makes it a really compelling dividend stock to buy right now.